Okay, so in today's class, we're going to talk about some concepts and some formulas to value a stock. So the magical answer is going to be, what price should I buy the stock at? And then you could look at the current stock market and see if the stock the valuation price is $25, it's currently trading at $5, that would be a stock to buy. So this chapter is going to give you the magical answer of what price you should pay for the stock. In order to do this, we made it develop a forecast of the stock. So forecasting a stock's expected cash flow, analyzing the stock's sales and earnings, dividends to help hopefully come up with a price that the stock is valued at. We're going to discuss again the concept of intrinsic value, acquired rates of return. These are things that we talked about in previous chapters, but we're going to bring them full circle in this chapter. The valuation models are classic. They're stuff that is taught in every finance class when we're looking at valuation models. And the classics are the zero growth model, constant growth, and variable dividend growth models for valuing stock. Now, the problem is everybody has these models and these valuation formulas. So the fact that everybody has them makes it a lot less useful. If you want to make money with a valuation formula, the most money you can make is if it's, first of all, it works, and two, if you're the only one that has it. Suddenly, if everybody has it, then they're going to trade the stock, buy and sell the stock until it's at that price. So one of the reasons the stock market is efficient is because everybody has the available formulas today and they employ them, and then the stock price is already based on those value calculations. But there's still something to be learned by understanding these valuation formulas, because sometimes stocks, their valuations get out of line, and the stocks may become too greatly overvalued or too greatly undervalued. So some of these formulas are a good way of justifying if the stock market has gotten to a state that's overreactive or underreactive in the stock prices. And and stocks tend to do that. For the most part, they're pretty fairly and reasonably valued, but there are beginnings and ends to bull markets. At the beginning of the bull market, stocks are classically very much undervalued, which these formulas will show you. And at the end of the bull market, which could be this year, next year, the following year, stocks will get very overvalued, and their PEs and multiples will be very high on average. So these formulations are good to sort of get an idea of, is the stock market the valuations of the stock market realistic? And we're going to use them on different types of stocks may require different types of formulas. For example, stocks that pay dividends can use these dividend valuation formulas. Stocks that don't pay dividends have different growth valuation formulas that can be used when dividends aren't present. So the basic concept is, if you're going to value a company, the value of the company is based on their future, not their present. Just like your earning potential is based on your future earning potential, not your current earning potential. So if someone's going to value your contributions to society, right now there wouldn't be much because you're just going to school. But since you're going to college, your future contributions will be much higher than if you didn't go to college. So you would be, in the stock world, considered valuable. So the value of a stock really depends on its future returns. And if you're an investor, you're talking about cash flow either way. So if you're an investor, one of those future returns can be dividends or capital gains the stock's going to pay. And that's why we want to invest in the stock, because of this potential successful future. Now, we want as much data as we can to get an idea of what the stock's going to do in the future, and the potential for its profitability. So we're not that much concerned about the past results. We really want to focus on the future results. Will this company's new products make the company significant money? So if Microsoft releases Office for the iPad tablets, will that help them to make more profits than designing the Surface tablet and selling it through the Surface tablet? Because remember that when they were trying to sell the Surface tablet, their big advertisement was you can only get Office on the Surface tablet and you can only get this Halo game on the Surface tablet. But they've been finding that people aren't buying the Surface tablet. Oh, the some they're thinking of discontinuing it. Yeah. That one of the reasons they wanted to issue the Office for the iPad is because they're kind of not getting the results they want in the sales of the Surface. The investors like the idea and they push the stock higher. So they think that Microsoft has more future potential selling software on the iPad tablets than selling their software through the Surface. This remains to be seen, so anything could change. But the stock has moved higher. Okay, so if we're looking at comparative data and we look at the the income statement, we can put things in a if we're trying to value stock, we want stocks to be comparable. So sometimes converting things into percentages or common size is a way that we learned from last chapter. We can make stocks within the industry comparable to each other if we're looking at all the financial ratios because they're all in the same. They're a percentage, not a total dollar amount. So it's very hard to compare medium-sized companies to large-sized companies to small-sized companies because they have all different dollar amounts for sales and profits. We really want to look at the percentages or the relationships between sales and profits and operating income and depreciation and things of that nature. So common size income statement is a way to kind of look at things as a percentage of sales. So if sales are considered 100%, then cost of goods sold would be 58%, gross profit would be 42%, selling administration expense would be 25% of sales. So we could look at everything in that relationship between the percentage, what percentage of sales are these different categories of the income statement. So if we had 7 companies we're looking at, we could sort of saw a relationship. We would want companies that have a higher gross profit and percentage related to sales, a lower selling and administrative costs related to sales, or lower total operating expenses. So this way, it gives us a quick way to look at many different companies within the industry to see how their sales are in relationship to their costs and their profits. And of course, the big one is what net profit is, what percentage of sales. Because net profit is, sort of what's going to turn into the earnings per share. Okay, so let's talk about the different steps in valuing a company. So we'll start with this 3 steps that are necessary variables to help us figure out what the value of a company would be in the future. And the first one, the most important one, and one thing you should definitely pay attention to and learn about in this class, is that profits and sales are probably the 2 most important contributions to the valuation of a stock. Meaning that we want to own stocks who are increasing their sales and increasing their profits. And we specifically like stocks that can increase their profits at the same or faster percentage than sales. So if sales go up 25%, we hope that profits will go up 25%, but we're even happier if profits go up 30% or 40%. Some of this could be an economy of scale scenario. So if you have the factory and you have all your costs and expenses already in place, and making an additional 1,000 cars isn't going to cost you that much extra, then your profit margins should go up and the more units you produce, because you could spread your fixed costs over more units. You become more efficient in the purchase of your inventories. So say you're Walmart versus a small store, they can buy in bulk and negotiate with vendors to cut their costs. And one of the reasons the Walmart stock has been very valuable is they've been very good at reducing their costs and passing part of the savings on to to shoppers, and pushing the rest of the savers into the returns of the company. After a while, it becomes more and more difficult to reduce costs. So a lot of investors in certain industries would just be happy if the company could increase sales and maintain the profit margins at the same amount, or hopefully don't lose any profit margin. So one thing investors don't like in valuing a company is, yes, your sales went up greatly, but you had to triple your advertising budget to increase your sales by 10%. So the overall result of profits or profit percentages are lower now because you're excessively advertising to increase your sales, and that's eating into your profits. So if your advertising expenses are not proportionally in line with your sales, then that's going to take away from your net profits. So these are things analysts would look at. They want to make sure the company is making all the right moves, that you're managing the company in a way that are consistent to show increases in profits and sales, and having hopefully profit margins increase faster than sales. Step 2 would be forecasting, using this information to forecast the earnings per share and dividends. So if you know the amount of outstanding shares and you can project next year's profits, you can project next year's earnings per share. And also dividends, if it's a company that pays dividends, and specifically if they tie the dividends to the earnings per share. And then the step 3 would be, I guess, forecasting the future stock price. So if a company is going to double their sales and double their profits, you can be rest assured that the stock price is going to increase. And the stock price will most likely go up more than double. It could possibly triple. So the more successive good news, the higher the stock price will go up. And that's why you'll have certain companies that could have $30 per share to start the year and end up $100 per share, like a Yelp, because they are exceeding the expectations of sales growth and profit growth, and pleasing and surprising investors. Okay, so if we're going to forecast future sales, we could look at historical trends as far as how the company has been growing their sales in the past, how they're related to demographics. So if a company, say Campbell's Soup sales, grow in relationship to the growth of the population. So if the United States population goes from 300 million to 330 million, Campbell's Soups can figure out that they're going to have probably a 10% growth in sales in relationship to the growth in the population. So that could be one factor of forecasting. Or it could just be that, a company like Chipotle Mexican Grill is growing 20% a year because they're opening 20% new franchise, 20% new locations every year. So it could just be that the company will give you a projection. We project to open up, maybe we're Panera Bread, and we tell you we're going to open up, we have 1,000 stores, we're going to open up 100 new ones next year. So you could reasonably assume that sales are going to go up by 10%. Now, so there are a number of forecasting methods to use to really kind of gauge the growth of the company. Now, one thing, companies sometimes provide guidance on their forecasted sales, and that's usually what most investors go by. Sometimes companies will, if you're Under Armour and you're going to forecast higher sales because now you've decided to go into the shoe apparel area. So in the past it was shorts and shirts and other protective gear and cleats, but now we're going into the casual shoe market and we're going to make Under Armour shoes, which is a much larger market. So they're going to forecast their sales to be higher. Now, the net profit margin can be forecasted as well. And some companies will give guidance on this, but many companies maintain a historical gross profit margin that pretty much stays around the same percentage. So if you have legacy businesses that have been operating for many, many years, they've managed to be able to contain or are guided to maintaining a certain profit margin, certainly never wanting to go below it. And they'll do whatever they can in the meantime to try to elevate that profit margin if they can, whether it's turning to leasing or if it's putting caps on vendors that supply raw materials or laying off employees. They'll do what they can. And that's why when a recession occurs and companies start to make less sales or less profits, they will do things like shut down factories, lay off employees, look for cost savings, redesign products, because they need to maintain that profit percentage, their profit margin percentage. And if a company does a really good job at doing that, we can get a good idea of what next year's profit margin would be, because it would grow at the same rate or be stable. If there's any anticipated changes, and that's why the industries that are difficult, like the airline industry is difficult, because we're not always sure what the price of jet fuel is going to be. and that's a significant cost to the airline industry. So here's the first valuation formula. If we're going to forecast the future earnings, we simply take our estimated sales for the next year and multiply it by our estimated net profit margin. So if we estimate $108 million in sales at a 6% profit margin, we can estimate a $6.5 million future earnings. Very simplistic formula, right? Okay. Now, if we're going to forecast the earnings per share, remember, earnings per share is closely tied to the stock price. So if earnings per shares go up, the stock price is going to follow, and investors are going to be quite pleased with this. So we always want to try to forecast the earnings per share so we can have an idea of the stock price. Now, last chapter we talked about the PE multiple. So if the PE multiple is 15 and the earnings per share is going from 5 to 6, and we expect the same PE multiple, and generally when earnings per share goes up, the PE multiple maintains or increases. But we're going to be conservative and say that it's going to maintain a 15 multiple. So at $5 a share, $5 times 15, I believe is $75. So that would be the stock price. If earnings per share goes to 6 times 15, it's going to be 91 or so, or $90. So that would be our new stock price. So if we could accurately predict the earnings per share, we can get an idea of what the stock price will move to based on the fact of a stable or constant PE multiple. So taking a step back, to forecast the earnings per share, we just need that future earnings after tax that we calculated in the previous problem, divided by the amount of outstanding shares. So if we know next year's earnings, divided by the amount of outstanding shares, we will get the earnings per share. So here, using that 6.5 million from last example, divided by the 2 million outstanding shares, we get a new earnings per share of 3.25. Now, if we estimate a payout ratio, some companies will give a payout ratio, which we talked about last class. The dividend payout ratio would say that whatever we make in earnings per share, we're going to give you back 40%. So this way we could estimate what the new earnings per share would be by multiplying the estimated earnings per share times the estimated PE ratio. So if we're going to get $3.25 in earnings at a payout ratio of 40%, we know that, let's see, we know that we're going to get $1.30 in next year's dividends. And if dividends are increasing, stock price goes up. So if you think of a stock that's $10 a share, in the first year they give you $1 dividend, the second year they're going to give you $1.50, the third year they're going to give you $2, the fourth year they're going to give you $3.50. There's in no world will that stock price remain $10 between those 3 years. The more dividends you pay, the more valuable the stock becomes, the higher the stock price. Okay, so let's go back to PE because I was tying that to a method of valuation. So the price to earnings ratio, which is the stock price divided by the earnings per share, gives a multiple of like. How many likes have been clicked on the stock? So if the stock has a price of $100 and has earnings per share of $10 a share, that's a PE of 10. If the PE was to increase to 15 and the earnings per share are still 10, that stock would be valued at $150, not $100. So it's just a measure of how valued the stock is. So each stock, there's an average market multiple. So the S&P 500 might have an average multiple of, say, 20. And that's just the average for all stocks in the market. But there could be a relative PE for individual stocks. So individual stocks usually carry their own PE multiple or their own amount of how much people like them and they've been buying the stock. More people like the stock, the more people buy it, the higher the PE multiple will go in relationship to the stock price. So if stock price is increasing, the PE multiple will increase as well. But this can be the relative PE for the stock will change if the future potential of the stock or the company becomes greater. It will change if the economic outlook becomes better or worse. So there are factors that float this relative PE around based on overall enthusiasm for the stock market. So if we're in a bull market and people are buying a lot of stocks, the S&P PE multiple may drift from 14 up to 18 for all stocks. So your stock will normally drift higher in its PE multiple because people just like stocks right now and they're putting a lot of money into it. Or there's no really any other investments worth any decent return, so I'm not putting money in savings accounts or bonds. I'm putting money in the stock market. So the greater demand in the stock market pushes all the prices higher, and the earnings per share may not follow as closely, so the PEs will go up. But we could use this, the fact that we know that if the stock has a growth in earnings, the PE multiple will increase. If the general stock market looks to continue being a bull market, PE multiple should increase. If the company's debt structure becomes less risky, the PE multiple should increase. If rates of inflation remain constant or shrink, that's good for PE multiples. And if dividends are going to be paid or higher dividends will be paid, that should also help demand and increase PE multiples. So if we're trying to forecast the PE of a stock, and we could get an accurate PE of the stock, and we multiply it by the earnings, we'll have a good idea of what the estimated stock price is. So we need our estimated earnings per share, which we have here, which we calculated. And if we figure that next year's estimated PE ratio is 17, we can accurately predict the stock price. And generally, we want to predict this for 1, 2, or 3 years out. So it's a pretty simple, it's a simplistic approach, but it's very effective. So if we understand that we expect the PE multiple to increase or remain the same, we have a good confident PE multiple, and we have good understanding from generally the guidance of the company, because the company will tell us this is the amount of earnings we expect to make. And generally they're trying to guide you a little bit lower so they can meet or beat their earnings estimate when they announce their earnings. So therefore, that lays the groundwork of understanding what the stock price should be next year. And if the stock is trading at a lower price than what we estimate it to be next year, it's a buying opportunity. And many, many investors use this very common and simplistic approach to buy stock. And that's why when an earnings announcement is announced and the company disappoints on revenues or profits, the stock price goes down so quickly because they're reevaluating what the price should be, because now we have a lower earnings per share, we probably have a lower multiple, and I thought it was going to be higher in both accounts, but since they failed to meet their earnings expectations, I'm going to have to revalue the stock. It's actually worth less. We sell it, and the stock sells off quickly on that earnings announcement. So you'll see, if you're following any stocks, pay close attention to the day of the earnings announcements and the performance of the stock. If they meet or exceed, the stock price will go up because they've underestimated the price. If they fail to meet or exceed their estimates, then the stock price will go down because investors have overestimated the price of the stock. And that's why we have such a huge price change on the day earnings are announced. All right. So this is just a table from the textbook, and it's looking at the actual growth rate in sales in relationship to, say, we'll have an average for 5 years from 2009 to 2013. So this average is something that we could utilize to forecast the sales figures in the future, depending how confident we are. Some companies grow very consistently. So if we have an average growth rate, we could say that's a pretty conservative growth rate to apply against the forecast. But there are so many factors involved that generally what we forecast is is hopefully close to, but not perfect to what develops. Because competition can develop. You could have something as small as Subway's franchises. Suddenly there's a lot of articles about the rubber ingredient they inject into their dough when they make their bread. So when you eat their bread, you're actually ingesting a polymer that's like a plastic they put into the dough to make it more elastic. So pretty gross, right? That news comes out, and then people are less enthusiastic about eating at Subway. Or maybe Taco Bell announces we're going to now serve breakfast, and we're going to serve the breakfast taco, which is a waffle, sort of like an Eggo, folded with some sausage and cheese and bacon in the middle. that could affect McDonald's breakfast sales, which is a significant part of their revenues. So then maybe McDonald's has to fight back and offer free coffee on Monday, which is going to eat into their coffee profits. But they're trying to maintain loyalty into their breakfast business, which is McDonald's has the most of all the fast food franchises. McDonald's has the most successful breakfast business. In fact, so successful that many fast food franchises just give up on trying to serve breakfast. There's a time when Wendy's had breakfast. Remember, they gave up though. There was Burger King still has breakfast, but they're even Subway tried to do breakfast and failed, and most places gave up on it. It's a hard business to get into. So these are all real world issues and problems, dynamics and products in the marketplace that are going to affect a company's sales and profits. So when Starbucks announced that they're going to sell breakfast sandwiches at Starbucks, McDonald's fought back by making McDonald's Cafe, where you could get frappuccinos and coffees and smoothies and stuff like that to compete more directly head on with Starbucks. So these are all factors that you can't always predict. But we do know that if the current price is less than the estimated price that we're estimating, obviously it's undervalued. And if it's equal, it's fairly valued. And of course, if the current price is much higher than the estimated price, it's overvalued. And if stock is overvalued, then, and you're confident about your results, you should sell it short. So in any scenario, there's something you can do. So this is basically, these three levels here are a buy, hold, and sell short or sell. So here you would buy, of course. Here you would hold or not purchase. And here you would sell or sell short. So that's how no matter what your forecast is, there's an action that you can take or an inaction. So valuation, this is the process of measuring the risks of a company and the potential rewards to determine what the stock price should be. So valuation models that we're going over in this chapter is just trying to figure out an idea of what the stock price should be. Because we want to know if the stock's going to exceed our required rate of return, we want to buy that because we're getting more return for less risk. The intrinsic value should be the point at where the worth of the stock equals the risks of the stock. So we're trying to put a point at which the stock has a balanced value. And of course, the problem is things don't work out as our forecasts or as clean or neatly as our forecasts and our valuation models. They don't always result in success because many things can happen. We may get the accurate valuation that day, but things can happen along the way. New competitors, new products, change in attitudes. So say you're Philip Morris and suddenly people in the United States don't want to smoke anymore or are deciding to reduce smoking or eliminate it. And there's a lot of ad campaigns, government support to eliminate smoking. What do? You go to China, India, where they have the two largest populations in the world, and you start advertising smoking. And you say things like it's unregulated maybe market, so maybe you say things like smoking's good for babies, or smoking's good for pregnant mothers, or you're not cool unless you smoke, or this cartoon character won't like you unless you smoke cigarettes, or you won't be able to fornicate unless you're smoking cigarettes because you won't be cool enough. These are all, by the way, those are all valid advertising campaigns they've had in the past, which are outlawed in the United States, of course, but but as a company, you need to anticipate these changes and then act upon it. There could be, in the future, in the United States, the majority common thinking could be that we don't like soda anymore, we're not drinking soda. And then Coke and Pepsi are going to have to sell more soda overseas or develop new products. And that's why this has actually been occurring over the last 10 years. People are drinking less soda and drinking more water, more non-carbonated drinks. Trying to think. Some of the fast-growing segments in the beverage market, like vitamin water or health-infused water. And there's even out now competition with people making their own soda at home through SodaStream, which is a stock that's done very well and a stock whose forecasts have helped push up the price of the stock as more and more people like this novelty of making soda at home. I think their success has a lot to do with if you ever do Christmas shopping for people and people who have everything, you want that next new product so you can make sure that they don't have it. So the Keurig coffee creator was a few years ago, and now the SodaStream is a type of product that you could get for somebody who has everything. And Keurig was, they took a sleepy little company like Green Mountain Coffee, who had very poor valuations, stock price wasn't doing well. They created this Keurig and those coffee pods, and the stock went insane because it turns out people like making coffee this way. Because it's easy, it's quick, it's easy, and if you don't care about how your coffee tastes, why not just throw a pod in and basically get your instant coffee? You know. Now, to calculate the required rate of return, which is an essential element in the forecasting of stocks, we need to understand, and this is the capital asset pricing model, if it looks familiar. And what we're trying to do is use beta as a measure of risk. So beta would be our measure of risk, and we want to amplify the market returns. But we don't want to amplify the risk-free rate. So that's why we subtract out the risk-free rate, which we could think of as like a 3-year treasury rate. And we just want to amplify the market rate by whatever beta's factor is. And beta we learned from chapter 5, maybe part of chapter 6. It's a measure of the stock's correlation to the market. So stocks that have a riskier volatility will have a higher beta, and the required rate of return will be higher as a result. So we can use this capital asset pricing model to calculate what our required rate of return would be for a stock. And then if our forecast showed that the return would actually be equal to or greater, then that would be a buy recommendation. This is just a quick example of if you had a beta of 1.3, a risk rate of 5.5, and a market return of 15%, then your required rate on this stock would be 17.85%, which was greater than the market return because the stock has more risk involved. Now, here are some stock valuation models. Some of these you may be familiar with, some of these you're not familiar with, but when stocks, there was a period of time where dividends were very common for stocks, and then in the 70s and 80s, as the taxes on dividends went very high, companies stopped paying dividends and switched to buying back stocks more. And now today, there's a healthy mix of stocks that pay dividends and stocks that buy back shares. So the dividend valuation models are one way to sort of evaluate companies who pay a consistent or growing dividend, like utilities or other income stocks. And we also have a price to earnings approach we're going to talk about, and then relative price approaches for companies that don't have profits or dividends. So we have a multitude of different valuation formulas based on different scenarios. Okay. So the zero growth would be sort of a preferred stock or perpetuity, that we would just use the annual dividends divided by the required rate of return on the stock to give us the value the stock should be. So it's the simplest of all the formulas, and all we need to know is what dividends are going to pay and the required rate of return, which we could use the capital asset pricing model to calculate that. And then we would get a value for what the stock would be. So when they say a zero growth dividend model, they're talking about preferred stocks because their dividends are fixed and they don't grow. And this is how we would value a preferred stock. And preferred stocks are one of the easiest stocks to value. Okay. Now what about a constant growth dividend model? So a model where the dividends are going to grow consistently. So the company will give you a growth rate, and they'll say that we're going to grow our dividend at 2% every year for the next 5 years, and that's a promise. We could use the next year's dividend, and there'll be a class handout where we'll be practicing these formulas and reinforcing them. But now I just want to give you the overall idea, and the overall idea is if we have next year's dividend, we take the required rate of return minus the growth rate, and we could calculate the value of the stock based on this constant growth model. Now, if the dividend is going to be a variable dividend, and this is more of a rarity, this would be sort of a company saying that here's a schedule of dividends the next few years, and these are $1, $5, $6, $2, and 50 cents. So in that case, you would want to use a variable model because the dividends are going to vary every year and not in a consistent way. So we could use the time value of money, discount the value of these future dividends, and bring it to uh, calculate basically a present value of these dividends to relate it to the price of the stock. And we could also take what we feel the stock would be and create a present value of that stock. So if the stock says we project it to be $25 in the future, we can actually use a discount rate to get the present value of that stock today. Maybe it's $20. Then we add to it the value of the future dividends. Maybe that's $6. So we come up with a valuation of 26 that the stock should give us in real today's money. If the stock's trading less than that, it's a purchase. So this is a rarity. This formula is not used very often because A, companies don't really commit to a variable dividend over many future years. Okay. Now a dividends and earnings approach would be finding the present value of the future dividends, say for 5 years, and then the present value of the price of the stock at the date that we're planning to sell it. So we would have to first give the future projected price of the stock, find the present value of it, and add it to the present value of the future dividend. So it's very similar to the dividend valuation model for variable growth, but here we're just applying it a little bit differently, where we're going to put the build the earnings into the stock price. And this approach is also not used that regularly. All right. However, this valuation model is quite common. I use it myself, and it's a staple of today's markets. And we're using, to calculate the stock price, we're going to use the price to earnings approach. And we discussed this before. We just take the earnings per share, the estimated earnings per share times the estimated PE ratio. And it's very simple to understand. And it's just basically saying that if earnings are going to be $5 next year and the price to earnings multiple is going to be 20, we know it's going to be a $100 stock. The tricky part of it is really estimating what next year's earnings per share are going to be in next year's PE multiple. That can be a little tricky, but it's just this is also, Yahoo will give you a valuation model at the bottom of their quotes. They'll say evaluation, next year's estimated stock value, and they're basically using this approach, the PE price to earnings approach. Now, we can use a price to cash flow approach where it's similar to PE, but we're replacing it with cash flow. So we're looking at the price of the stock divided by the cash flow per share. So instead of using the earnings per share, we want to use the cash flow per share. Because cash flow is a more realistic number to the actual money the company is generating. Because income reflects the fact that we're taking depreciation out of the earnings to get net income to reduce our tax exposure. So cash flow adds back those depreciation, and it's considered a more realistic approach. So if we wanted to substitute earnings per share for cash flow per share, especially in certain industries with cash flow, the income is greatly artificially reduced to avoid taxes. The cash flow ratio would be a much easier approach to work with. And it works the same way. You basically estimate the cash flow per share and then figure out next year's cash flow, and you can get the stock price. Now, if the company has no profits, you can also work with sales. So the common stock price divided by the sales per share to get a multiple of this price to sales approach or percentage. So what we're looking for, if the company has a consistent stock price based on a multiple of its sales per share, and it doesn't yet have any profits. So it's one of these types of companies that comes out and it's, like a Facebook or a Twitter, and we don't have really reliable profits to look at the point of time when they're a public company. Although I think Facebook has profits, I know Twitter doesn't. We could use this sort of the sales relationship to stock price in lieu of profits. So if we have a stock that's not profitable, we could see that every time they double their sales, the stock price doubles. And that would be a very easy one-to-one relationship. So if we see that we develop that relationship and sales are going to increase by 25%, we can expect stock price to go up by 25%. So again, it's just tying the price of the stock to the price to sales ratio, or using the multiples of sales in relationship to stock price to help us predict future stock price. And for some companies, people get very excited in the fact that they're doubling and doubling and tripling and quadrupling their sales so quickly, because that means eventually, hopefully, they'll be able to turn that into profits. So the more sales you have, the theory goes, the more potential you have for profits. And companies that are growing their sales quickly are going to have part of that sales growth reflected in the stock price. So this price to sales method is a way of measuring that. Okay. We can also look at the relationship between the price to book value. So again, these are all similar to PE multiples, but where for stocks that the earnings don't reflect well on the actual value of the stock price, we do these alternate approaches. So the price to book value, we're going to look at the market price of the common stock divided by the book value. And the stock price should always be higher than the book value. So if we have a stock that maintains a consistent relationship of, say, a price to book value ratio, we'll say of 3, the stock price is 3 times book value. Book value is $5 per share. Stock price is 15. And what book value is equity. So it's the assets minus liabilities. We get our equity. Divided by the outstanding shares, we get our equity per share or book value per share. So if we have a company that is suddenly generating a higher book value, meaning they're becoming, the equity of the company is becoming larger, and that has a direct relationship to the stock price, then we could use that relationship to help predict the future stock price. And for some companies, you may use a combination of these valuation approaches. So you may look at book value and sales and profits and use more than one to sort of come up to a consistent approach of what the stock should be, because they all are somewhat connected. Okay. All right. So this is a short chapter. So in this chapter, we talked about the role, how closely the future is connected to the current stock prices. So today's stock prices are not the valuation based on today's actual stock numbers. They're the valuation based on future stock numbers. So if we look at the income statement and balance sheet right now, that's not what the stock price is based on. It's based on next year's pro forma future balance sheet and income statement. So looking at today's financial statements really would tell us how accurate last year's stock price was. Or we could actually take today's financial statements, develop these relationships between book value, sales, earnings per share, cash flow, to where the stock was last year, and see how reactive the stock is to changes on these characteristics. And once we develop an idea of how much of a percentage the change is, we could look to next year's estimated financial statements to figure out next year's stock price. And it works very well. The only thing that messes it up is when the economy changes, or something goes wrong with the company, or a news item is related, or there's government regulation. So that the company, it could be a company that's a pharmaceutical that, next year their drug is going to go generic, or the government is going to say that this is no longer a safe medication, we're taking it off the market, or you're going to transition to over-the-counter. These are all things that they could happen unexpectedly, and that's going to mess up all your valuations because you didn't predict for it. So based on the financial numbers alone, you can get a pretty close approximation of where the stock price is going to be. It's all that risk in between buying the stock today and what's going to happen if it's actually going to come true over the next year. It's all that risk in between of earthquakes and events and governments and military interventions and unexpected competitor moves, price wars, all these things in between. And that's usually, say, a company, industry like the airline industry. Things could be going very well for the airline industry, and you may have a predictable stock price for next year, but then boom, a price war starts. Same thing with cell phones. Right now there's a price war between AT&T and T-Mobile, which is destroying the profits of both companies. That wasn't factored into the stock valuations. So that's why the stock valuation processes, we're doing them every day. We're updating them every day as a new piece of information comes in. So we're not doing it just once and then leaving it. if you're following a number of stocks and you're making these stock valuations, every new piece of information that's released, you're going to have to recalculate and refactor in your stock valuations, and that's why stock prices change every day. The more accurate you are at forecasting the future sales and cash and profits and dividends, of course, the more accurate your forecast will be. And what the basic concept, what we're doing here is we're trying to calculate intrinsic value. So we want to develop the true value of what we still feel a stock should be. And that's a very difficult thing to do. And that's why the stock market prices change so dramatically. And a lot of these, when we go over these actual formulas on Monday and we start doing some work with them, many of them are ineffective because, like I said earlier, everybody has these formulas. So they're no secret. So the stocks are pretty close to the valuations. If you have accurate data, you'll find the stocks are actually pretty close to the valuations that are being calculated, because everybody's calculating them and applying them and buying and selling accordingly, and that's how we get the basis of what we say is an efficient market. Now, depending on the situation of the stock helps dictate what valuation model you're going to use. So stocks that have profits and consistent profits would use more profit-oriented valuation models. Stocks that rely most on dividends would use the dividend valuation models, and stocks that have no profits but are focused more on revenue growth would use some sort of per share variable tied to revenues. And the more you apply these valuation models, practice with them, and get ideas of what the stock price would be, and you analyze what happened between the 6 or 12 months between your valuations to see how accurate you are, you get a better idea of what things could happen along the way that can destroy that. Hopefully the valuation is changing for the better, that the stock price is going actually more higher than you estimated. So if you have a conservative valuation that shows there's about a $3 appreciation you can make in the stock price, and then the stock price appreciates $5 or $6 because of better earnings or a better economy, you're not going to complain about that. But now you have to start valuating for next year. So I made my profits, the stock market went up $6. Do I hold it again, or do I revalue and does the future look even better? So these are all things that, Chapter 8 kind of helps you to understand as a conceptual framework, but it doesn't give you the very answer you're looking for, which is, tell me what's the price of the stock I could buy right now and make money next week. Because it's a more longer term approach. Okay.